What is up, everyone? So today I want to talk about the most recent stock market decline that we had this last week, with the Dow declining about 700 points on Thursday and about 450 points on Friday. And we are now almost back down to the lows that we made back in February, with the SPY trading around 258, and it made a low back in February of around 255. So we are getting very close to those levels. So I want to talk about really why you should use this as really a buying opportunity. You just have to look at this objectively and take emotion. As always, when you're trading, investing, whatever, anything with money, you have to remove all emotion out of it, especially with trading. Whenever you become emotional about trading, and really anything with money for that matter, that's really bad. That's when you really start to lose a lot of money. And in these situations, it's really best to just take a step back from the whole situation and take just more of a holistic approach. It seems like every year we have something that makes the stock market decline. It's actually quite healthy for the stock market to decline. About once every year we have about a 10% correction, and when the market declines 10%, that is called a correction. When it pulls back 5%, that's called a pullback. And then a bear market is when we go down 20%. So right now we're down about 10% from our highs back in January, when the SPY topped around 285 and the Dow topped around, I think, around 26.5. Right now it's trading slightly below 24,000, I believe. So this is really just a very healthy correction. Back in February we had a pullback or a correction of more than 10%, and now we're retesting those lows. So this is very healthy. It's just really important to not get emotional about this and look at this as a buying opportunity, because that's what it is. If you have stocks that you've been wanting to buy forever, but you just think they're too expensive and you're waiting for a pullback, well, this is that pullback, and this is a great opportunity to buy. And no one can ever time the market, so it's always kind of tricky. You don't want to catch a falling knife in these situations. Like Facebook, they declined 15+% from their highs with their most recent scandal, and I've been buying along the pull down, and it's it's scary because you don't want to catch a falling knife, and you really don't know when it's going to stop falling. But the most important thing is the economy is very healthy. We have a pro-business environment. With the most recent tax cuts, the whole world economy is, performing really well. And, the most important thing of them all is we still have an inverted yield curve. And, in a couple of videos ago, I went over, how important the yield curve is. It's forecasted every single recession in the past 100 years. So if you haven't already, go back and watch that. I go into more detail on, why this is such an important thing to monitor. And like I said, it's forecasted every recession in the past 100 years. But that doesn't mean that we can't have stock market declines of 10, 20+%. Like 1987, the economy was very healthy, but the stock market declined more than 25% in one day. And then over the next year, it went on to make back most of those gains. Those things can happen where the stock market gets just overheated. The economy is still really performing very well, but the stock market just gets overheated, and we get a 10 to 20% pullback, which is really quite healthy. And it's important to remember that the stock market and economy aren't always directly correlated. You can have the economy performing really well, but maybe the stock market's like it is right now, it's somewhat overvalued. The underlying economy is U.S. economy and world economy is just performing so well, but the stock market is very overheated, overvalued, whatever you want to call it. So that's what I think we're experiencing right now. Like I said, we're down 10% from our most recent highs. From here, I think we could definitely retest the lows in the S&P 500 of around 255. Right now we're at 258, so I think we could definitely retest those. But the most recent cause for this was the trade war fears, which every year it's something. Back in, I think, like 2014, it was like Ebola. It caused a huge stock market decline, which you look back at that now, it's like, what? Why was anyone ever really even scared about that? That's like the dumbest thing ever. But that presented a really great buying opportunity for a lot of people that, wanted to buy some stocks that they have been wanting to for the last year but haven't had the chance, and that provided the perfect buying opportunity for them. So, to touch on the yield curve again, since it is still, inverted, I do not see the economy slowing down for at least another year, 2 years plus. Once we do get flat to inverted yield curve, that's when I'll start to get worried and probably start to take some profits in a lot of my positions. That doesn't necessarily mean that you should go out and sell everything once we get that flat to inverted yield curve, but it definitely means that you should take a more protective approach in the market and investing and in your portfolio. And that's what I'll do when we get to that point. But we're still, a year, 2, 3, who knows, maybe even more from that situation. So from here, I'm going to, use this as a buying opportunity. I don't think we have too much more downside, but, you never know. So yeah, that's it for this video, guys. I just kind of want to go over, this most recent stock market decline. I've been doing this for, 10 plus years, and every time we get these corrections, I get scared as well. But the most important thing is to, just take a step back and do not get emotional about it. And that's really the most important thing, is to leave emotion out of it. So yeah, I hope you guys enjoyed this video, and I'll see you guys in the next one.